What's up, guys? Hope you guys are all fine. I'm here to do an interpretation of the income statements, historical income statements, and my projections that I did for Sonangol, that is a company from Angola. So I'm working in my final project for high school, and I choose these how can I say, I choose this topic because as I told, I have interest in finance and those things. So it was interesting since I did an accounting high school, do a projection of the results of Sonangol. Here we have our historical income statement from, as we see here, historical, that in English is historical income statements. Those income statements are historical. Those datas that we have here, 2019, 2020, 2021, 2022, 2023 are all historicals, but I searched for the margins and did a projection. So I used two methods to do the projection. First, I used the one typical method that I just saw the growth of revenue, like we have here, from the sales, revenue of sales. Vendas is sales in English. This vendas is in Portuguese because the project should be in Portuguese, because it's going to be to my final project in high school. So I can't write it in English, so that's why it's in Portuguese. Here we have vendas, that is sales, and I just saw the growth of sales. For example, here we have services provider for clients, and I also did the growth of it, like in 2020 to 2019, and this I'm going to show you guys. And the second method that I just saw the growth of revenue, the total revenue, those let me highlight, those three items are from revenue. First we have sales, then service provider for clients, and the third is other revenues. And here we have the total of revenues. I just saw the growth of the total revenue and in the second method, and then I just saw the margin of EBT, that is the earnings before interest and taxes. No, I mean I think I didn't did the margin for the EBT, but I did for the COGS, that is this, the here in Portuguese is custos das mercadorias vendidas e das matérias-primas consumidas, that is the COGS, that is the cost of goods sold, or good sales in English. So I also did the margin of it in the second method. Has percentage of revenue, like that is how I calculated the margin. And I also calculate the the EBT margin, that is the earnings before taxes. So I divided the EBT by the revenue, the total revenue, for me to gain a margin, and I did it for all that, as we have here down. I'm going to show you guys. um, I also saw the margin of the taxes divided by the EBT, for me to see how much percentage of EBT is being paid for taxes, because it's not only one tax that this company Sonangol pays. Like they pays a lot of taxes. So yeah, it's good to me to know how much percentage of the EBT they are paying in taxes. And I also did the I also divided the net income divided by total revenue for me to see the margin of the net income as we have here. So first, I'm going to explain a little bit what an income statement is and how I did the projection for this company, Sonangol, that is an Angolan company, as I said, and I'm going to use this model. Of course, we are going to have tests and those things, but I'm going to use basically the basis that is in this model for me to use in my final project in the high school. So first of all, an income statement is one of the most popular of the three financial statements. That here we measures the revenue of the company, the revenue that one company is generating, the expenses that a company is also generating, and the net income or the profit that one company made in one period. That the profit basically is the net income, is the revenue, the total revenue that we made in 1 year, minus all expenses that we have here, like COGS, like we have here, the custos das mercadorias vendidas e das matérias-primas consumidas, that is COGS, and other OPEX, like OPEX, when I say OPEX, is operation expenditures, like the payments of salaries and those things to our employers, like we have here the custos com pessoal, that is the salaries, and we also have here the depreciation and amortization. Here we have only amortizações, that is basically the same as depreciation and amortization, and we have also other costs here that are operational expenditures, or OPEX. We can just say OPEX, that is operational expenditures, and we also have like financial results, like from interest. This is interest basically in English, and other results here, non-operating results, as we have here, and we also have the taxes. So the net income, no, the total revenue minus all these expenses, all these like financial expenses, like interest or taxes or depreciation and amortization, or salaries or payments, salaries payment, or the COGS, that is the costs of goods sold, or other costs, minus the net income. We are going to have our minus the total revenue. We are going to have our net income as we have here, and the income statement basically in short terms measures all these things. So first, for me to do this projection, I had to pull up the historical income statements. So I did a projection for the next. First, I did for the next for the next 3 years, and then I did for the next 5 years, using the first method that, as I said, I saw the growth of sales, for example. I saw the growth of service providers. I saw the growth of other revenues, and yeah, I didn't include the growth of the total revenue. I saw the growth of these. Basically, I saw the growth of COGS comparing to the last year. I don't know if it's the right method, but it's one of the methods that I used. I saw the growth of all these costs, and the sum of those, we had the EBIT, that is the earnings before interest and taxes that we are going to see in the next sheets. But then I also saw the growth of interest and those things, and I project the results in the first method, as I said. And in the second, I just saw the growth of the total revenue and did the margins of the main things here, like the total revenue, the COGS, the EBT, the taxes, and the net income for me to project to the next years. I saw the average of growth in those years, and I project for the next both 3 years. That is the most optimal. I think it's this optimal scenario, um, and. And for the more negative scenario, I don't know if that is the right term, but for the negative scenario, I did for the next 5 years, because like as we see here, this company in 2020, we saw a huge negative net income. So for companies like here in Angola, it's normal to have those results. Like we have 35, I think it's billion. Yeah, I think it's 35 billion, talking in English. Like you see that those are huge numbers, but our currency is very it has minus strength compared to like US dollars or euros or those things. So yeah, it's not like a huge number, like comparing to big currencies. Basically it's just a couple millions of dollars or euros or pounds, I don't know. So we had 35 billion in total net income for 2019. Then we have 2 trillion, I think it's 2 trillion, trillion. I think it's 2 trillion in minus 2 trillion in net income. That is basically a catastrophic result for this year in this company, and you can see that you can see that um, this company is very volatile. I think it's this, because not a normal company has this difference between, even in COVID, like companies have to have reserves, like for these emergency times. So 2 trillion minus 2 trillion in net income, it's a huge number. Even in dollars or in our currency, it's a huge number. So yeah, the company is very volatile. That's why in the projection, I consider that the projection for the next 5 years is the more negative, because it includes the result of COVID-19, and that was very, very bad, as we see here, like minus 2 trillion kwanzas in net income. It's a huge, like comparing from these 45 billion in revenue in net income in the past year. And then we have 1 trillion, as we have here, 1 trillion kwanzas in net income for 2021. That we basically solved a little bit of problems of this year, but we still on debt, because this number is not bigger than this. So it has a difference between 1 trillion in negative results. And then we have um, 838 and 38 billion in revenue in net income for the 2022, and 930 in 2023. Like that is normal results. Like we can see that for 2022 we decreased a little bit, but in 2023 we basically grow a little bit, not much, but a little bit in total net income. But we can see that I think we're still negative if we do those numbers minus. I don't know. Let's calculate here. Let's calculate here. Those. I think it's plus because. Let me see. It's plus. Plus. Oh my god. Let me see. So this plus this plus this plus this. I mean, we. So I don't know why. Yeah, we're negative. We are positive in the overall. Basically, 720 billion in the past 4 years. But yeah, based on the margins as we have here, as percentage of revenue, we have 1% for 2019, minus 68 in 2020, 24% in 2021, 30% in 2022, and for 2023 we have 12%. That in doing an average we have minus 3%. So in our income statement, if we do a projection, we are going to see that this company basically loses money in the overall because of this minus 68%. Of course, if we do here a median, let us see a median if it's a positive number. If we do a median, basically it's going to be 12% because of this growth in the past in the past in the past 3 years. We can see that of course this company can grow a little bit more in the next 5 years, even if it's showing basically a decrease in their results. It can grow like 3% or 5% or 4% based on our assumptions. That's why in financial modeling, assumptions are the key. But we can see here that this company basically is decreasing in their net income. So if we can, I think it's 12% median is not realistical, telling the truth, because we can see that we had 1%, minus 68%, 24%, and we decreased by 20%, as you see here. It's very volatile in like big companies like Tesla and those companies. We can't see things like that. And decreased also 1% in 2023. So we can expect, like based on seeing those results, I think the using the average is the best. It's the best tool to see. Oh my god, average is média in Portuguese. I forgot that my Excel is in Portuguese. So using the average is the best tool because this company really loses money in the overall because the net income as percentage of revenue is decreasing. Basically, we had a strong how I said that, a strong growth in 2021, but is decreasing in the past 2 years. So yeah, the past 3 years, if we can see, like 24%, for 30, for 12. So this average basically, if we based on just these three numbers, we can say that the company will grow like 8%, then it's going to be in 5% basically, and yeah. So they lose money in the overall, but this is not the first method that I use. First, I'm going to to talk about the first method that I use for do this projection. So here in the second sheet, we can see that I did the premises. There are assumptions for for the projection, to do the projection or the forecast of their results. So here we have the same the historical income statement. As I said, I saw the growth of all these items, like for sales, service provider, and those costs that are OPEX, that are operation expenditures, and for those also for interest and those things, for the tax. I think the taxes are the only one that I used the same method, that was basically dividing the taxes by the EBT, because it's what makes sense, because the taxes are really are really percentage of the EBT. So I didn't see the growth of it. I just did the margin divided by the EBT, that are the money that we really pays taxes. It's not like the revenue. We pay taxes of the money that we subtract all our our expenditures, are OPEX and non-OPEX non-OPEX, yeah, non-operation expenditures. So yeah, for the I just did for the subclasses, like we have here the taxes. I didn't do for the EBT, but I did for all of those. In the sum, basically is going to be the EBT, and for all these items as we have here. So coming down, as we can come here, I think I have to put the sheet a little bit. Yeah, I think it's good. The zoom it's good. So for 20, I think also for the COGS, I also did as percentage of revenue, but just for the COGS, and for COGS, or cost of goods sold, or in Portuguese, if you want to know, de custos das existências vendidas e das matérias-primas consumidas. And here for the taxes, I did what I told you guys. So here for the sales, I don't have I don't have growth, because it's basically, I will put a formula, it's basically it divided by the past year for us to see the growth, and we don't have a past year, so it's going to be 0, as you have here. Basically, I use the formula if error, so we can see that is 0. And for the next years, as we have here, the formula really function, because we have the present year divided by the past year minus 1, for us to see the percentage of growth of this company in the long by the with the time, as we have here. So for us to see the growth, comparing the as I said here, comparing the present year divided by the past year, for us to see the growth. So we can see here that in 2020 has it was expected for like it's a large company, but they aren't sustainable in the long term. Uh, yeah, for basically for the net income, because for sales they are good. Like we can say that in like for 2020, basically they have minus 23%, as we can see here, comparing the present sales by the past year sales. But for the 2021, basically they had a growth of 60%. That is a good number. um, they were they were increasing their sales by 2021. For 2022, they also had a growth of 12%. That it's not bad. For real, it's not bad, because basically they were trying to basically they recover the losses here of 2020, and now their plan is to establish their sales. Basically they also try to improve, but the focus is to stable their sales by, as we have here, 5 trillion, 6 trillion kwanzas in sales, and they grow 25% in 2023, comparing the 2023 results by the 2022 results minus one, that we can see the percentage of growth. So I did the median, the median, no, the average. I used the average to do my projection, and we can see that the average of these are 19%, 90% of growth in the past 5 years. So that what I use for my projection, that we are going to see in the next sheet. Um, for the service provider, for clients, they actually grow in 2020. That was the year of COVID, and for the next like 2 years, they lose money. Their service provider decreased by 25% in 2021, and decreased to minus 2% in 2022, and in 2023 they basically almost double their service provider revenue for 85%, that we had here, average of 24% per year. As I said, Sonangol is a company very volatile, and even if they are one of the largest companies here, they are not stable. Like as you can see here, 1 year we have 38%, then minus 25, and like, yeah, for investors, some investors that don't like these how can I say, I think they are not stable in their revenue. Even in their revenue, we are also going to see that in their other results they are um, um, we are going to see that they are not stable, and their results vary a lot. So, but we had an average of 24%. Here we have the other operation results that basically grow. They had a growth of 22% for 2020. For 2021, 20%. For 2022, minus 32%. And for 2023, basically they had 47%. That we had an average of 50%. As I said, for the totals, I didn't did the growth margin, the growth of this of the total revenue, but in my projection, the sum of all of it was my total revenue basically. So that's it. Variação nos produtos acabados em via de fabrico. We had minus 104%. Basically, the growth, the negative number, and then we had 1000%. That is very huge, and minus 172, and minus 91, yeah, and yeah, we had an average of 257%. Then we have our COGS, that is the cost of goods sold, as percentage of the revenue. We can see that it's basically a little bit stable percentage, but they are increasing their COGS in the long run, so it's not good for the company. We can see that in 2019 we had a COGS of 90%, and for 2020 we had 26%. That basically it increased for 7%, and for 2021 they increase the COGS as percentage of revenue, but only a little bit. And the number just still grow for the next 3 years, as you can see here. And for me, it's not good for a company with this size to grow their COGS a lot, because it can means that they're spending much cash over the years in COGS. So it's not good for investors to put money in a company like that, because they are increasing, their sales are also increasing, as we can see here, but the percentage here of COGS is also increasing. So it's a worm for them to adapt strategies that they can use for improve their efficiency in managing the cost of the COGS, basically, or the custo das existências vendidas e das matérias-primas consumidas, because it's not good for the company to grow their COGS in the long run, because this number can just grow for like you can expect this number to grow by 40, 45, or 50% of the total revenue, what is not good. Basically, they are going to have only with the COGS, they are going only to have 50% of their revenue to their cash, and minus all the other expenditures like other OPEX or non-OPEX, like payment of salaries or other things. They are going just going to have a small margin for their net income, which is not good, and their shareholders basically won't have much money. They are not going to have much money for their shareholders, which is not good for investors. Then we can see that we can see other costs here, or other OPEX that grow basically 29%, also has average. The salaries that also increased. Yeah, that also increased. Yeah, 21%. Basically, the growth of the salaries, and we have the amortization that I can also use as percentage of revenue, but yeah, I just in this method I just saw the growth. We can see that they grow 5% per year, basically in those 5 years. You can see other costs that increase also to 35% per per year, which is not good because our growth of revenue is just 90%, and the other revenues, we can see here a growth in none of these three items of the revenue, like increasing by 30% or something like that, but we can see that 200% for other for the cost, which is basically not good for the company. Then we have the interest. The interest basically we can see minus 6% growth, which is a little bit good. Results of investment, we can see that they had a good result by investing in other companies, like 500%, which is really good. We had a 900% growth in 2020, which is really good. Like one of the things that really growth has revenue, even it's not from operating, it's not operating revenue, but it's good for the company. And then we can see minus 92% in 2021, minus 21% in 2022, and the and 1000% in 2023. But we can see that has average is good, but it's as I said, it's not a stable growth, because like they grow like 900, but then they go for minus 92 and then minus 21, and we can see that it's not stable. Like we can see here, like 2024, like minus 500, for example, or minus 68 or something like that, and it's good, has average as we have here, but in the long run it's like not a stable results that we can just expect like 500% on it. And the thing that amazed me the most was this: the non-operating results, that we can see here are decreased by minus 7,000%, which is huge and impressive, guys. It's really impressive. It contributes for the results that we are going to see in our projection in the financial statement using this method, because it really shows that this company had like 5 billion, as we have here in, or I'm going to be here and highlight with the mouse. Here we can see 5 billion in non-operating results, and then we have 1 fucking trillion in minus 1 trillion in this, which is very huge numbers, guys. It's really huge numbers. We here in 2021 they tried a little bit to increase this number, of course, and yeah, we finished this with minus 1000%, which is the true number. I can invent another number, because those numbers are not stable. As I said, this company is not stable, even if it's one of the largest company in Angola, and which provide the most revenue and money for Angola, but it's not a stable company. I don't know how they trust only in this company, but it's not a stable company. And yeah, minus 1000%, as we see here, and the sum is going to be our EBT, and the taxes I did dividing by the EBT for us to see the margin. As we have here, we have a tax higher than the EBT. I don't know why, guys. I really don't know why. I just took out it in their financial, in their annual reports, in their income statements, and I saw that. And yeah, I just don't know how they can pay more taxes than what they did in the year, but it was it in 2019. Um, for 2020, they just paid 10%. For 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 2021, they paid 28%. 2022, 41%, and for 2023, 33%, which is a little bit huge comparing from US. Basically, in the US they just pay 21%, and yeah, but this include just other taxes, like um other taxes like from importing products and those things. And yeah, we see an average of 22%, which is really good. Then we have the the extraordinary results that we can see minus 47%, but because we don't have the in 2023 it didn't have this extraordinary result. I didn't do the projection of it, and then is here my projection for the next 5 years. I mean, I'm not going to explain in the next 3 years because it's basically the same logic that I use. This projection is from their uh, 5 years results, like since 2019 to 2023, that I used to project for the next 5 years. And we are going to see this projection. Oh my god. So as we can see here, in the as we have here the 5 years projection, I used the same sheet, the same model for the projection. So I you guys can see here that hard-coded numbers are in blue, for you guys to see that those are the numbers that doesn't have formulas, and the formulas has that is in black. So I saw the growth here. We have 90%, and I had those results. I'm going to also interpret those results in another video. I just this for this video I'm just going to explain how I project, then I'm going to also do an interpretation of those results. And we can see here the growth of 24% has we had there has the growth, and also here the same, and the sum of it we had the total revenue. I also did the same here for the growth. The COGS basically as percentage of revenue, and here is it. Then we can go downside, and it's basically the same thing. And I did the sum basically of this total revenue plus by its minus because this number is negative. The OPEX that is operational expenditures, as I told you guys. Then we also have the interest. We also have the results in other companies, in investments that we can see that really grow over the years by this 500%, and the result that just I mean bring for the company this hedge losing results that was this minus 1000%, and we can see that this company had not a stable result in the long run, as we can see here. And in the last year 2028 we had like minus 50 trillion, I think it's this kwanzas in non-operating results, which is really bad. And like for a company with this with this responsibility for the country, it's not a really good sign. And you can see the taxes here as percentage of EBT, and we can see here our net income, which we can see that increased in 2024, increased a little bit in 2025, decreased in 2026, and increased a little bit in 2027, and really decreased in 2028. But it just reflects the past results, as they vary also, as you guys saw in the past, that they have not a stable results. And we can see here the margins, as we can see here, the margins of their operating results for EBIT, and we also can see the COGS margin and their net income margin. As you can see here, those are huge numbers, minus 70,000%, which is based on our assumptions, and that is this based on what we collected as data. So I can say, like, yeah, we also can do a projection, or we can do an assumptions based on their growth and see that, yeah, minus 7,000%, as we have here in the upside, and just project it, but they are very not stable results. So I had to use the average, and the average gave us these results based on this first method. And for the past 3 years, there are more stable results, of course, as we can see here. Here in the premises, that is assumptions, guys. So we can see here for the let me down the zone a little bit. So for the sales, 12%, and for the in 2023 for the sales, 25%, which gave us 90%, 42% for the service provider for clients, and 8% for the other operational revenue. And we can see more stable results. 28 for the COGS margin, basically minus 35. We can see that this number grows by the years, so you can expect like more 5% of growth on it. But in this method I just used the average, so it's this. And I just did the same as I did in the first sheet of assumptions. I just saw the growth. In the other items, and for taxes, as we have here, it's percentage of EBT in the taxes, and I just found the margin. And for the COGS, as we have here, I don't know why it's not going to the COGS. Yeah, we finally there. For the COGS, I just found the margin between the COGS divided by the total revenue, that which gave us 28%, 35%, and 37, which, as I say, this number grows over the years. It's a margin that grows over the years, which is not good, and this company has really to improve their efficiency costs. Yeah, I used I think no, I really used the same metrics that I used in the first assumption, so I don't need to explain all of these things. It's basically the same as I did in the past assumptions for the next 5 years, but using only the results of the past 3 years, as we see here. I just had the historical net income, no, the income statement of the past 3 years, so we can see more stable results because it's before or it's after COVID. And yeah, but of course, using more data, it's always better because it provides us a long-term view, of the company, and for investors, that's what they precisely want to do. They don't want to do. They don't They want to see. That's what I wanted to say, because they don't want to just see. 1 year net income and they just decide to invest based on it. They have to have a clear vision based on their past income statements. It can be the past 5 years income statement or the past 10 years income statement. In income statement or in cash flow and balance sheet, there are many metrics that they can use for investing in a company, but income statement, balance sheet, and cash flow are the main. Here we are only using the income statement because it's what I'm going to use in my final project in high school, in accounting high school. So yeah, that's why I'm highlighting the income statement, but you guys also can use the balance sheet and the cash flow statement, because the cash flow is more precisely because it refers for the cash, um, or if you calculate the levered cash flow, it's even better because it just with levered cash flow we can see how much the company has uh, really in the true cash flow that they have, the levered free cash flow, I mean, because it means it it measures the cash that they really can give for their investors. So as I was saying, just the 3 years income statements, it's good, of course, because the past 5 years also have the COVID's results, which were not good as we saw, but it really measures the the growth of the company all over the long term. The investor don't want just to see a growth in 1 year or 2 years. They want to invest in a company and maintain the investment for years, for 5 or 10 years. So they have to see really their income statements of the past 10 years or 5 years to them to see how much is this company generating in net income or cash flow, or how they are managing their liabilities, if we analyze the balance sheet, or if they are increasing their assets to increase their assets, if they're buying more assets to increase their net income or something like that. So it's a good projection for the using the past 3 years income statement, but I think the more sustainable is to use the past 5 years or the past 10 years or 8 years. It depends of you. if you decide to invest in a company. And I basically use the same here. I calculate the growth. We can see that the sales really increased by 90%. The service provider for the clients increased also, and other revenue, the other operating revenue also growth, and we can see a total really good, like 30 trillion for the next next 3 years, 2026, which is good, using the optimal side of the assumptions based on the past 3 years. And we also have here the costs. Now we also have here the COGS, that is has percentage of revenue, total revenue, and we can see that even here, minus the cogs and on the OPEX, that are all the operating expenditures, we still have two 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 trillion has EBIT, which is good. I think it's good. And let me see. We are really here. We can see that we are really spending. It's a non-cash expenditure, but here in the income statement we put that we are really spending much cash in depreciation and amortization, and for COGS also. As I said, the COGS are increasing by the time, over the years, so it's not a good sign. Even if we are still positive, as we have here, they have to improve their efficiency to cut some costs, costs cut some cogs to improve their net income, because increasing their cogs over the years, it's not a good sign for the company. And as I told you guys, if we go down here in the assumptions of the cogs, it's here, as you can see. It can go for like 2024, like assuming that they can grow 2 or 3%, they can go, or 4, they can go for 40, and 2025 they can go for 35, and which is a huge percentage of the total revenue. And we have here the EBIT, and we also have the interest has grow in they grow over the time. And yeah, we can see here an EBT. We can see the EBT, and we also have the taxes as percentage of EBT, which is also, they don't vary a lot, which is good, because it's just 22%, I think. Or yeah, for the next 5 years, 3 years, it's minus 34%, which is a little bit huge, but okay, it's okay. And we have here the net income, which grow all over the time. We can see here 900 billion, 4 trillion, 40 trillion, and 400 trillion, basically, kwanzas, in total net income for 2026. And we can see the growth here, the margins that I saw. And yeah, we can see that for this company, Sonangol, this part really shapes the whole model. This part, that is the 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 non-operating results, the result of investment, and the interest really shape our our net income because those numbers really vary all over the years. Like the other numbers, like the OPEX and the sales, really varies a lot also, but it's just 20% to 30% or 40%. And for those, just these numbers are really random, and they can grow like 1,000% and then go down 5,000, which is it's not good for you. It's not good. It just it can be just how can I say it can be just a present result which in the long term we cannot have those results, and can really affect our net income. So I think they have to improve those areas. I'm going to interpretate their result in another video, but here in this video I just wanted to show you guys how I did my assumptions, how I based my assumptions for this projection that I did for the next 3 and 5 years. Then we also have this projection that, as I told you guys, I did based on the growth of total revenue and the margin of COGS, that is the custo das mercadorias vendidas e matérias-primas consumidas, as percentage of the revenue, the operating results, that is the EBIT, as percentage of revenue, the EBT, that is earnings before taxes, as percentage of revenue, and the taxes. Oh my god, I think I can add this for 25. Okay, that's good now. The taxes that I did has percentage of the EBT, as I told in the past, and the net income that I did based on the has percentage of revenue, basically. So we had this for the next 3 years, which is a more sustainable model that we can see really the not including those huge percentage of interest and those things. And yeah, it's a more sustainable model. We can also see here for the next 5 years, which I use the percentage based on the growth of the past 5 years. Here I use the growth of the past 3 years, and those percentage are from the past 3 years. And here we have the percentage based on the past 5 years, basically. And as we had there, -3%, we can go down and see the -3%. Let me go there. I just linked the numbers. Here we can also have 22% for the taxes that we have here, 2% for the EBT that we had also here, as you can see here, and we have 12% for operating results or for EBIT, which we can also search here, 29% for the COGS, which you can see here, and 90% for the growth of revenue, which we can also have here. And for the past 5 years, we can see the margins here, which is 90% for the growth of total revenue, which we can see here. I linked from the from that sheet, um, the COGS has percentage of revenue. We can also have here 90%. Um, the operating results are the EBIT minus 33%. We can also have here um, the results before taxes, which is the EBT. We can also have here 25% and also here 25%. And the taxes has percentage of EBT minus 34%, which we can also have here. And net income has percentage of revenue 16%, which we can also have here 60%, which is linked in this sheet basically. So it's a more sustainable growth, as you can see here, and I'm planning, I don't know why I'm going to use in my project for real, but I'm planning to use the sustainable model because yeah, for that model that I did in the first method, the numbers um are really random, and yeah, it really shows. I think I'm going to use the two of them because it really shows that even if the is the larger company in Angola, um, it's really random their results, and they have to improve their efficiency if they want to still in the market for the long run. So that was the video. I hope you guys really enjoyed